Because when we think about venture capital, it's a bit like rocket fuel. It gets often compared like this. You can put it in your car, but if your car's not able to take off like a rocket, it can be very like harmful for the company.
This is Melanie.
And this is Christian.
You're listening to Follow the Gradient, the weekly podcast with actionable insights about how to build a business while staying sane.
Welcome back to another episode of our Follow the Gradient podcast. We are tackling a topic today which drives many people crazy and can make or break an entire business: receiving funding from a venture capital firm. There are many materials out there on the pitch decks yielding the most successful funding rounds or the best way to do cold outreach to a VC. There are also many viewpoints out there who either glorify venture investing as the one goal in life of an entrepreneur you need to achieve, or they cry it as VCs being the dark side of the force. Neither viewpoint was something I could identify with, nor did I personally ever think that seeing the pitch deck of Stripe helped me in any way craft a story for my own venture. What I was missing was a rational point of view on how venture capital is positioned among all the different forms of investments out there and the different asset classes available to deploy money in. And more importantly, what these dynamics mean when answering the question whether venture capital is the appropriate form of investment for a particular startup.
In light of this, we appreciated the really fresh view our guest gave today on the topic. Henrik Grosse Hokamp, partner and co-founder at Berlin-based VC firm Revent. He neither positioned venture capital as good or bad, but explained its investment dynamics and incentive structures in simple terms, so you can decide for yourself whether VC is the route you want to take with your venture or not. In addition to that, Henrik shares which business models are suited for a venture capital investment, how to judge if a VC is the right partner for your startup, what elements to include in a successful pitch to a VC, and the most common mistakes founders do when preparing a financing round.
Before we kick off, a personal message from us. We're doing this podcast as a side hustle to help people through the craziness of startup life. If you like what you're hearing, sign up to our free newsletter at followthegradient.io. There are exclusive insights Henrik is sharing only in this week's edition, which he hasn't shared here on the podcast.
And now, without further ado, let's dive in.
Henrik, welcome to the show. Can you share what brought you personally to founding your own VC and give an overview on what type of work you guys do at Revent?
Yeah. First of all, hello, Christian, Melanie. So over the last 10 years, I actually worked in different venture capital firms. So I worked originally for these big US, European funds, where I invested both in very early stage companies up to companies that were already quite mature, which had proper market fit and were just pre-IPO companies. And then over Corona times, we really thought about, okay, what would we do if we would just had already all the success that we needed. We had already all the money that we needed. And we always came back to the idea of hey, we would really like to work with early stage founders to help them, to enable them to solve big societal problems. And that's how Revent came to be. So we raised our own fund. We focus on companies that tackle problems in societal and planetary health. So we focus on problems in climate, in education, in healthcare. And we do that really at the earliest stage. So we work with founders when they just think about the idea, when they've raised the first round of financing. And we help them to build a strong foundation to attract more capital and to build really big businesses.
And what struck you most about venture capital investing compared to these other financing forms such as PE or traditional loan giving?
I think it's very different things. It's actually probably two ends of a spectrum. When we think about private equity, there you invest in companies that are quite mature, that are very stable, have predictable financials, and that can attract leverage from banks. Venture capital, on the other side, you don't have any like security. There aren't any cash flows often. It's just really like a founder and an idea to change the world. So venture capital, what always attracted me, it's these ideas that you can shape the world to your own beliefs, where you really can say, hey, I have this vision and I bring this to life. You create something out of nothing. And to work with these kind of people and see this transition happening is just such a fulfilling task. And it's a lot of fun, actually.
So now that we have founders as our listeners and startup operators, I would be very keen to learn many founders ask themselves how to get funding from a VC or whether VCs are actually the right partner for them. Can you explain what a VC-backed company looks like and what the characteristics are that need to be met?
Yeah, this is actually a really, really important question, because we see that if you get this wrong, it's actually very painful. I often say founders should first think about what kind of problem they want to solve, what kind of customers they want to attract, and only then think about, okay, how do I actually want to finance this journey? How do I want to build these companies? In today's society, in startup media and podcasts, we hear a lot about venture capital, but I still believe venture capital is actually a bit of a niche solution for only a few companies. So I often say, like, first of all, like, think about how you would do it otherwise. And only if you believe that venture capital is a right fit, like, choose it. Because when we think about venture capital, it's a bit like rocket fuel. It gets often compared like this. You can put it in your car, but if your car's not able to take off like a rocket, it can be very like harmful for the company. What venture capital investors actually seek are like companies that can become huge in a very short time. Because venture capital as an asset class is very high risk. Most startups fail. And so the startups that actually work need to be massive winners. And a lot of founders underestimate what it means when we talk about massive success. We had recently a founder that came to me. He was like quite disappointed. He raised money at just once, sold his company for like 20 million euros, life-changing money. And the investor was like very upset with him, like, because they just doubled their money. It didn't matter for them. So what venture capitalists actually seek is like one company can return the whole fund. So if you say if VC owns 10% in your company, then your company needs to be 10 times the size of the fund. And when you say like the VC has like 100 million, 200 million funds, this means like you have to have €1 billion outcome. And this is like really, really difficult to achieve. So for that, you need to have a lot of tailwinds. You need to have a big market opportunity in which you can grow into. You need to show like significant growth. And that's very difficult to achieve. And a lot of companies, just given that they address like more smaller markets, a certain niche, they sometimes are like phenomenal businesses, but they just don't reach this venture scale and they don't fulfill this criteria. And if you then start to raise venture capital, you put yourself on a very slippery slope, because you have shareholders that will push you to build something big, and you will feel that the market just doesn't give you the opportunity to achieve this. And you will be pushed to raise more money, which will be difficult because investors will see that you struggle. And then we see often companies that could become like normal, good businesses go bankrupt because their burn is too high. They can't address, they can't seek new funding. And yeah, thereby they don't succeed. So before you raise funding, really think about, do you want to get on the track of raising continuous amounts of capital? And do you really want to build a very, very big business?
And maybe to really make the point what you just said, because I feel, and I can also talk from personal experience, I wasn't aware how the business model of VCs worked in the first place. And I think many founders struggle to understand what the incentives are for VCs and why there is always this next round, and why they actually, in our discussion before we recorded, you talked about the power law. Can you maybe really make like listeners understand, like, and dive a little bit deeper what this is and what it means for the business model of the company?
So venture capitalists, they seek capital from big institutional investors. They raise a fund. This is like basically a pool of capital that they invest over like a few years. And then the fund has a lifetime of like 10 to 15 years, in which they basically wait until these companies become big and then they sell these companies. VCs, as investors, they receive part of the winnings, like part of the earnings of the fund. So normally they receive 20%, what we call carried interest of the winnings. They're like hugely incentivized of returning significant amount of capital. The venture capitalist investor in one fund invests in 20 to 30 companies. Of these 20 to 30, we expect 2 to 3 to actually pay back the investors' money. Why don't we like target like smaller like companies, smaller exits, and then just say like we target safer companies? There are multiple reasons. First of all, it's very difficult to predict what a safe company is. Even a restaurant is highly risky, although there's like very little upside often. So the second factor is it's very difficult to sell a small business. If you sell a company that's worth like 10 to 100 million euros, you often talk about like an acqui-hire. So we sell the company to one of your competitors, to big corporate. But these buyers, they are only interested in the founders. They really want to have like the things that are in the head of the founders, the skills. Thereby, they often hugely incentivize the founders, and that doesn't create a significant outcome for the VCs. And when we look at historic data, it really also shows that once you hit product market fit in a big market, there is tremendous upside. And it's like, it makes a huge difference if your company goes from like an 1 billion euro exit valuation to like a 2 billion euro exit valuation. This doubles the whole return. This makes the investor's return go from 10x to 20x. So although it's just like a doubling of the company's value. So this growth at the later stage really drives the returns for VCs. And thereby they really push founders to achieve this stage. The other factor is, if you think about a venture capitalist, you just said they have like 10 to 15 years of timelines, and they need to tell their investors that they're successful. But how do you do that? Like, the only thing you can show to your investors is often how much follow-up capital did your company raise. So this is like a bit of a slight conflict of interest, actually, because you say like, on one hand, we want the best for our companies, but on the other hand, we also need to explain to our investors, which we call limited partners or LPs, that our companies are successful. And we need to tell them, hey, in company X, like Sequoia just invested and gave us a huge up round. So this is like where we often need then to push our founders to think about, okay, like let's think about your next funding round. Let's think about who we can bring in.
I'd like to focus on what these different points about the dynamics of VC investing, which you just talked about, right? What they mean for founders or for startups in general, which are actually now seeking a VC as a partner. So what does a founder have to pitch to you or to a VC in order to be considered and to be heard in the first place?
I think there's two things that are critical here. Number one, and we talked about this, is there a potential to build a very, very big business? And you normally show that by showing a massive market opportunity. And market opportunity doesn't mean market size. Market size is often like, let's say the pet food market is a huge market, but there might not be like any opportunity to disrupt it. While when you think about some of the biggest businesses in the world, their initial market looked very niche. If you look at Uber, it was like black cabs. It was like such a niche market. Airbnb was like staying at other people's homes. It's like very niche markets, but there was the opportunity because there was a shift in society. The second point is, besides this massive market opportunity, is your ability to actually take advantage of this market opportunities. And there we look at different things. Is the founder team the right one? Like, do they have a certain kind of right to win? Do they have an insight that some people might not have? Do they have a belief where they say like, oh, actually, we believe that given this technology trend is continuing, we believe there is actually a chance to take this market opportunity, which was previously locked up, to take full advantage of this now. So we really seek these two things. Is there an opportunity, and can this team take advantage of this opportunity? And this comes potentially from your background, that you worked in this industry before, but you like saw something that other people didn't see, or you stumbled across something, which is like actually happens more often than you would think.
And when we now take this from a conceptual level to the level of, you look at an actual slide deck or a pitch deck, right? Because oftentimes this is how you get submitted the idea. When you look at a slide deck, what questions, and you kind of touched upon this already, but what questions do you ask yourself when you evaluate these pitch decks?
Yeah. So I think one thing you really need to understand is that the amount of pitch decks and the amount of deal flow venture capital investors see in like a normal firm sees like 1,000 companies a year. So they look at like their funnel very much like conversion driven. They really look at companies. What companies are the likeliest to become investments and then become big businesses or big outcomes? So often there's like what you look at for index is like, okay, what I just mentioned as well, like this market opportunity, like is this like really clearly articulated? Like not just putting some numbers on there, but like explaining why this is happening right now. And the strength of the team. I mean, we invest very early stage, right? We invest in teams. When you look at later stage investors, they often look at any signs of traction, like any signs that this is that can you prove that you are actually able to take advantage of this market opportunity? And when you raise your seed or Series A round, you really want to show product market fit, and that you show by initial customer love. Like you want to show that there's a pull factor. But we often don't have this luxury because we invest so early that there's like there might not be a finished product, there might not be any customers. So we really need to find proxies, which are often the founding team.
Let's imagine you have considered someone after looking at the pitch deck. You do a discovery call. What are the things you're looking for in the discovery call?
I believe when we look forward is two things, and they might sound contradictory. Number one, we seek people who are a bit crazy, right? You often seek people who have this like strong belief of changing the world and really going for it. And especially like if you talk to European founders, this is often lacking. They are very, very articulate, very reasonable. They know their numbers, but they lack this kind of visionariness. And when we seek founders, we often seek people that are able to sell. They are able to sell their vision to their customers, to their first hires, to future investors. So you at one point seek this like visionary craziness. On the other hand, you also look for people who want or like understand their challenges that they will face. They understand they're like realistic enough to take market feedback, to understand what it takes to hire great people. So they can't be like up in the clouds and dream about introducing general AI when they don't understand like, okay, what does it actually take? So you seek like people with a strong belief and strong vision, but also people who then take market feedback and are able to execute on this feedback.
Now, like what I would want to go back is to your number that you said of thousands of slides per fund. Now, when especially first-time founders hear that and they don't have a network of VCs that they can reach out, they maybe don't have people around them that could give warm interest to VCs. What do you suggest to such founders? How can they build up a network and how can they approach a VC? Do you just cold call, email, like you do with sales, or how do you get hold of a VC that he or she actually opens the email? Because if there are 1,000 emails in your mailbox, I guess you don't look at each of them if you don't recognize the name.
I actually think founders should not just raise from one C in their first round of financing. We believe that especially business angels, mentors are crucial when it comes to building up a business. It's just like another sparring partner that you have along the ride. What we need, and thereby like I often suggest to founders, hey, don't start with venture capitalists. Like talk to people that are like other founders in your space. If you build a company in the energy space, look what are other venture-backed energy companies. Like try to meet these founders at conferences, try to meet them at like industry dinners, and really try to network for two reasons. Because these founders can often share their learnings and can be like very crucial in doing all kinds of first steps you need to do to build a business. But they often have also like investors on board, and they have often like already an extensive investor networks. And where we see that, where our best leads or best potential investments come from are often from our portfolio founders or founders out of our network, because they understand what venture capitalists look for. They understand when we see this, we already see, okay, you actually engaged in the ecosystem that you will work in. But I also have to say, like, if you like just want to go directly to venture capitalists, you can actually reach out cold. I would suggest nonetheless, especially in times of ChatGPT, to really figure out why do you want to speak to a certain investor. Like look at what they have done before, look at what they get interested in. And then you can actually make a targeted reach out, but then really explain why you want to speak to them, and not just be like, hey, we're raising money. Do you like it? Yes or no? Because in reality, these emails get hardly opened, and you need to build a connection. You need to you need to at least have this initial spark, which creates enough interest that people engage with your company.
I think you really, as a founder, you also want to have somebody on board that understands your industry. You want to have somebody that has invested in complementary startups. So this person also can help you on the board. So that is one thing.
Yeah.
And then the other thing that might not be obvious, and maybe for smaller funds is different, but often if you reach one partner, the chances that if this is not a fit for this partner, that he or she then gives the deal over to another partner is very low. So this is why you really need to make sure that you reach out to the right person at the fund that you want to have, and that also understands your language. That's just from a founder perspective.
Yeah. And I would say it's also both ways. You also want to find a venture capital firm that is a great fit for you, because quality in our industry varies highly. And it's often not the one that you find with your first Google search. It might be like specialists. It might be like people that are like now very well known in the ecosystem, but not very well known in the public medium, maybe. And thereby, I really think you should talk first to people who raise money, who build businesses, and they can often very easily, they just can guide you to find the right person for you.
We had Ruth last week on the show, who also talked about the importance of storytelling. And I find your points are pretty interesting, that they are consistent in line with what type of story do I need to tell the potential fund, and why would this be relevant to the fund. On the flip side, what type of mistakes, or what are the most common mistakes you see people do when they reach out to you, or when they are trying to make a pitch to you?
I think the most common mistake that we see is this lack of understanding of what venture capitalists look for. We often see founders who say, I can become profitable with this funding in a year, and then I never have to raise capital again. And they explain to us that this is like, it's a great achievement. I don't want to make this discredit this, but it's often not the right thing that funds look for. Funds look for these huge outcomes. And I think this is still the biggest issue where like founders seek venture capital because it looks like a cheat code, like a hack to bridge this first gap of finding customers and finding revenues. And what we also often see is that founders don't understand with what investors they talk to and what like also how to build momentum in the fundraising process. Because if you have never done a fundraise, it's very difficult to understand, okay, this is how this process works. This is what kind of like information I need to show. So this coming back to this point, seek advisors, seek people that have done this before. This could tremendously help your conversation and help your conversion.
We had Amy Levin on the show a while back who talked about how media relations are about long-term relationships building with journalists. And our guest Francine shared a similar notion when it came to nurturing investor relationships when it comes to laying the basis for a partner lineup for M&A. So what is your take on this with regards to how founders should approach relations to VC in general?
It's very interesting topics because you hear very different viewpoints on this. The common saying in the industry is you want to build a relationship with the investors long time ahead. You want to have these conversations. In reality, I'm not so sure that's actually true. In venture capital, what is a very competitive industry also from the venture capital side. So there's probably like a couple of companies every year which you need to find as a venture capital investors. When you change your LinkedIn profile from, I don't know, you worked at Google and then you become a stealth founder, you will have like 10, 20 venture capital investors reaching out to you just because they scrape LinkedIn data. They look for like any kind of market insights. And in this case, like if you can do it, it is often also okay to run a bit of a competitive process and try to get the different venture capital investors interested in your funding round. Because also the truth is once you get one offer from one venture capital investor, you will get a lot of offers from a lot of venture capital investors because it's very difficult to judge what is a great team. And a lot of investors look left and right. What are other people doing? I think it's the wrong approach, but it's still the trend and the dynamic in the industry. So my suggestion would be twofold. Yes, figure out if there's like one or two investors that are like perfect fits for you. And then talk to them early, talk about what you want to build and build this relationship. But also if you have already some initial connections to venture funds, try to run a competitive process. Try to speak to multiple people. And especially if you raise follow-up financing, you want to have like competitive processes also to make sure you can raise capital and can raise capital at the best terms also for you. And I think the same is true for M&A processes, right? You want to have a certain relationship with buyers, but you also need at least two parties in this process. Otherwise, you don't build the necessary dynamic to close the deal.
Now, once you have received funding from a VC and you have established the partnership, from your perspective, where do you expect then the company to go next in terms of within 1 year, within 2 years, within 3 years?
What our biggest goal is to build a very big, valuable company. So this is like achieving the Mount Everest, right? But you don't push to Mount Everest in one go. You go like from the base camp to camp one and so on. So we often think the same way when we think about how we scale businesses. It's like we define certain milestones that the company need to reach. And often these milestones align also with the milestone that you need to show for the next fundraising round. Normally, founders raise capital for 1 to 2 years. You normally want to have at least 2 years of money in the bank, but you start normally fundraising again 1 to 1.5 years after you received funding. So we need to make sure that in 1 to 1.5 years, you reach your milestones. So this is also what we look for when we invest in companies. Okay, will they be in a good place in 1 to 1.5 years to receive this additional capital? Then we work with the founders post-investment to track, okay, are we still on track to achieve these milestones? Can we potentially steer the company by decreasing burn, figuring out a certain pivot to make sure that they are at a good place in this 1 to 1.5 years time? And you don't want to wait 2 years, because if you run out of capital, or if you need to raise capital at the last minute, it can be very painful.
What are these kind of milestones? Maybe you can give us some example on the one hand, and on the other hand, there is this saying that from series to series, you need to achieve a 2 to 3x valuation increase. Is this still you also look for, or is this still from the old heydays where money was very cheap?
As you mentioned, we see the journey of a company in different financing rounds that we call series. There's this pre-seed or seed round that's happening in the beginning, where it's really about financing the founders, then often just the idea. Then the next round is the seed round, which is you want to show initial product market fit. You want to show that the product works, that customers love the product, and there is a market pull. And then for the Series A, you want to show them the first, million euros of recurring revenues and so on. This obviously depends highly on the kind of business that you run. Is it software? Is it hardware? And so on. But what investors look for, as you mentioned correctly, Melanie, is that you can show that the value of the company increased meaningful. And yes, normally what we target is 2 to 3x still. We have seen companies that really outliers that can raise even higher valuations. There are cases in the industry where there's 10x difference between last round and this round, on the next round. But the main goal is build the business. Don't think too much about valuation. I often, we as venture capitalists in your company, as board members, we will think a lot about your funding. This is why you have us on board, to track future funding as well. You should focus on your customers. You should focus on your revenues. You should focus on building this company. And that's why I often urge founders, think about your company first and about investors second. And it's also when we talked about this initial, do you want to raise venture capital? Think about what's best for the company. This is always the first mantra, first idea. And then think about, okay, how do we finance it? And once you have venture capitalists on board, if they know what they're doing, they will work with you very closely to figure out what are these milestones, how do we achieve that, and who are the investors that you need to speak to when you want to raise.
Oh, Henrik, we would have a ton of more questions, and I think there is definitely room for a follow-up interview on how to work best with a VC after funding and prepare you for future rounds. In the meantime, if you have one advice for a founder seeking VC funding, what would it be?
Show your true passion. And it's especially true for, again, European founders. A lot of founders try to make a logical case for a business. A business that is can become a huge outlier company is always a bit counterintuitive. Otherwise, this company would already exist. So, and we as investors are also just people, and we seek founders with which we also enjoy working, and where we feel that these founders will attract the best talent. And just be honest and just be show your passion. Don't try to hide it. Don't try to be too professional. This is again a bit what you probably don't hear from other people, but this is where there's often this is a little thing which makes fundraising more fun. and which also will attract investors to join your ride. And it is a long journey you get onto. So you better work on something that you enjoy, that you want to build, and you want to find people that share that vision.
Thank you very, very much. How can listeners get in touch with you or learn more about your work?
It shouldn't be too difficult to find my email, but also you can reach out to me via LinkedIn. We are normally quite responsive. Again, we enjoy the job that we do. We want to work with founders that are building like tremendous businesses and solving real problems. So just come up when you see me, like even at events, just say hi. And yeah, like we enjoy just hearing about great ideas, great companies. So please feel free to reach out.
Thank you very, very much for being on the show with us.
Yeah, my pleasure.
This was another episode of Follow the Gradient.
And now we would love to hear from you. How did you like it? What should we improve? Do you have any suggestions, ideas, or dream podcast guests? Please let us know.
Thank you and see you again next week.